Is it tariffs or tariffs? The free markets aren't feeling very liberated today, are they? Right. So yesterday, the Trump administration announced a rather shocking 10% baseline tariff on all imports, with even steeper rates targeted at China, the EU, and Japan. And the immediate market reaction was, well, I'm sure you've seen it, pretty brutal. And even supposedly insulated stocks are jaw-droppingly dropping. And for those of you short on time, here is what my trading desk experience tells me matters most. This appears to be an initial overreaction based on historical tariff impacts, bond market signals, and yes, sector-specific resilience. So you're about to discover exactly which sectors might actually benefit while others collapse. And look, I spent nearly a decade analyzing these exact market shocks, actually a little more than a decade if I'm honest about it, and I've paid hundreds of thousands of dollars to the leading investors and the leading traders out there for mentoring services. And what you'll learn in the next few minutes could literally save your portfolio from unnecessary losses and position yourself for surprising gains. Now, I want you to take out your phone, unless you're watching this video on your phone, and open your investment app. Seriously, do it now. Look at your 3 largest holdings and ask yourself, are these positioned correctly for what's about to happen? And this simple check could save you thousands of dollars already. And did you notice how quickly certain stocks recovered from the initial shock while others continued falling? This pattern reveals something critical about what's happening beneath the surface, something most retail investors completely miss. And speaking of patterns that most investors miss, this tariff situation reminds me exactly of what I've been teaching about 16,000 people the last 4 or 5 years. How do we anticipate big market moves? How do we position ourselves for the recovery? How do we protect our money from the crash? And let me show you just how useful this information is, because this is what people are emailing me today. Felix and Winston, I'm so happy I listened to you and sat on my hands. Thank you. And I'm not showing this because I want your gratitude. I'm showing this because I want you to learn the rules, and then you don't need me. That's my entire goal here, that we get to a point where nobody tunes in because everyone's like, I know what he's going to say. That's actually what I want, because at that point, we've achieved our mission here. So if you want to learn the rules that this lovely lady learned, who's just messaged me the thank you, go to felixfriends.org/get-free. Forget this video, this one here, completely forget about it. Just don't watch it. Just go to felixfriends.org/get-free and learn the exit rules and the entry rules, because there will be the mother of all rallies after this crash is over. And it's the same system that's helped me achieve retirement here in my early 40s. Hard to tell, I know I look so young. But look, let's actually analyze exactly what's happening here and what it means for your money. So the administration has unveiled what I call, tariffs for everybody and then some. And at its core, we're looking at a uniform 10% baseline tariff on all imported goods coming into the United States. But that's just the starting point. China, the European Apparatchik Union, and Japan are facing significantly steeper levies beyond that baseline. So pay close attention, because this next bit is really crucial for understanding market movements in the coming weeks. These tariffs aren't just simple import taxes. They include what Trump is calling a reciprocal tariff, designed to counterbalance trade practices he views as disadvantaging American interests. The baseline 10% kicks off on April 5th. That's just literally hours away from now. And the reciprocal measures, that's a difficult word, isn't it, follows shortly afterwards. So this staged implementation is, telling. And why? Because let me give you some historical perspective. The current situation bears some resemblance to the 2018 US-China trade confrontation, where we saw initial market panic followed by eventual stabilization as investors adjusted their expectations. Now, Winston has chewed through my old trading journal from that time period. I wish I could show it to you. He has excellent taste. But here is where things get particularly concerning. Today's economic landscape is fundamentally different. Global trade now accounts for more than 13% of GDP, compared to less than 4% at the beginning of the century. This is the last time we had these kind of high tariffs. So write that down. 13% of GDP is now trade. It was 4% at the time pre the Great Depression. And this increased interconnection means the policy shocks can be more rapid. And honestly, after years of voluntary monetary policy adjustments, markets are particularly jumpy right now. Think of it as like a caffeinated trader. We say caffeinated, but you know what I mean. And he's being handed another triple espresso, and the reaction might be a bit, well, excessive, perhaps. So how did markets actually respond to this bombshell? Well, in one word, poorly. After hours, we got immediately panic selling. And it's even stocks like Palantir and SoFi, which really aren't exposed to trade policy shifts, which are dropping like 8%. And that's what we call in the industry a correlation one environment. Everything moves regardless of fundamental exposure. It suggests fear rather than rational behavior is driving prices. And have you noticed how this announcement follows the classic Art of the Deal Playbook? Honestly, it's a good book. It's really fun to read. I read it about 15 years ago or something. And this looks remarkably like the maximalist opening position of a Trump. Start with demands that seem outrageous to create a negotiating leverage, and he's giving them a few days to come to the negotiating table. Have you noticed? 10% now, the additional tariffs a little later. So I'd be genuinely surprised if these tariffs remain at these levels permanently.
It's worked the total opposite. Inflation.
But do you think it's fair that you have tariffs on a whole number of products?
That's right. And we'd be willing to take those off tomorrow if he took all the tariffs off.
Look at what's already happening. Ontario Premier Doug Ford is proposing mutual tariff elimination between Canada and the US. Now, while he can't make binding decisions for the entire Canadian federal government, it demonstrates how quickly this announcement is triggering responses. Zero tariffs is what he's saying. None, nada, nichts, null. So what's your gut telling you about this market reaction? Is it a proportionate reaction to the economic impact, or is fear driving this? And look, it's not just retail investors hitting the panic button. Wall Street's biggest players are sounding the alarm as well. Goldman Sachs has released analysis suggesting these tariffs could trigger a dangerous trifecta: spiking inflation, stunting growth, and raising recession risks. And the economists aren't exactly known for being alarmists. Well, they're also not exactly known for being right. But yeah, they raise some concerns, and it's worth paying attention. To be fair, dismissing these risks entirely would be a little naive, although most people do laugh at the economist that works in a bank because they're kind of just like, I don't really know what they're there for. I think they're there to go on CNBC and just sort of hold the brand up, but nobody really pays any attention to economists usually. But if these tariffs are implemented exactly as announced, and that's a big if you're asking me, we're looking at a genuine economic threat. Higher consumer prices across basically everything, with some exceptions, semiconductors and so on. Potential supply chain disruptions and a drag on growth, at least for the short term. The European Soviet Union has already vowed retaliation. No surprise there, although they're just trying to find where they put that paper where they agreed on something, because generally speaking, they don't really agree on much. And when we get the punches coming back, they usually get bruised. American exporters could find themselves facing similar barriers to their products abroad. But it's really the scale and the suddenness of this announcement that as investors imagining the worst case scenario. It's human nature, really. Ask yourself this: have you ever sold an investment during a market drop only to watch it recover a week or a month later? Be honest. Most of us have made that mistake at some point, right? And if that's you, just put a 1 in the chat, and then I know that you are one of the ones who's regretted that. And that's exactly what's happening at a macro level right now. History suggests these overreactions are typically self-limiting. And where uncertainty peaks, investors dump everything indiscriminately, but once further data emerges and we realize that, well, Microsoft's still there, people are still watching Netflix, people are still killing themselves with Coca-Cola and pharmaceuticals, and people are still going to Starbucks because they're a bit depressed and all that kind of stuff, and that the American enterprise is just a very, very strong one. American companies are pretty much the best in the world, and American entrepreneurs are, well, basically unrivaled. Irrespective of what loon is running the government, the current panic appears to be, well, a little overblown. Why? There are two major unknowns, and I love that phrase. Known unknowns. So we have one: what retaliatory measures might other countries take, and how quickly will the Fed intervene and cut interest rates? And these are concerns. So do these tariffs cause massive inflation? Well, that's basically what people are worried about, right? Now, they're essentially a direct tax on imported goods. And basic economics tells us what happens next. Businesses facing higher import costs will inevitably pass on some of those expenses to consumers. It's not a question of if prices will rise, but rather by how much and how quickly. And is there a domestic alternative that might now be cheaper after you pay the tariffs on the foreign nonsense? But, and this is critical, the current US economy has some remarkable buffers in place. The labor market remains tight with unemployment below 4%. Consumer spending is pretty resilient. Corporate balance sheets are very healthy, plumped up by years of money printing. And these fundamentals provide a lot of protection against, economic collapse. And what's the Fed gonna do? Because this is where things get really interesting. There is a rather compelling theory circulating among Wall Street that these tariffs are actually designed to force the Fed's hand on interest rates. Think about it. Create enough economic dislocation and market volatility, and the central bank almost has to respond with more accommodative, lower interest rates. And for investors maintaining a long-term perspective, and I'm talking, 5 years plus, this potential Fed response actually represents something of a silver lining. Rate cuts typically support stock valuations, encourage investment, and stimulate the economy. And at the same time, the US government has to refinance some staggeringly large amount of debt this year. I think it's 9 trillion or something. So what they've been doing is wanting to get real interest rates out there in the economy down from the 5%. And guess what? They have succeeded so far. Interest rates have fallen almost a percentage point to now about 4%. Now, 1% on 9 trillion over multiplied by 20 or 30 years, which is how long these bonds typically are, I don't have to tell you, that is a lot of money. So for once, we do actually seem to have somebody in charge of US government who's taking a longer term view and is prioritizing the longer term economy over the short term. And we're confused by this because politicians don't usually do this. Politicians usually just want to be popular today and not in, a few years. So it's a very, very unusual setup that we've got here, which is why I think so much of the market is so confused by it. But I think we've just created some beautiful opportunities for level-headed investors who can look beyond the immediate headlines. You've got a little bit more calmness, got a little bit of cash on the side because they had good exit rules when the market started to come down. I'm still sitting on a lot of cash. So let's take a look again at a couple of stocks like SoFi, for example, which logically should be pretty insulated from direct tariffs, right? Yes, they dropped 8% on the news, panic selling. Financial stocks, primarily domestic financial stocks, why are they moving on trade news? It means that people are just anxious. So take a look at your portfolio and see which of your holdings have been hit hardest and are they actually exposed to import costs, right? Okay, if you're Apple, I get it. You make most of your stuff in China or Vietnam or somewhere like that. And, you're going to have to pay more for that until you remove to the different location. Right, so we've established this is likely an overreaction, but that doesn't mean every sector will be equally affected. In fact, some will benefit from this and some will be hit pretty hard. So let's run through the important sectors here. First, financial sector. Banks and financial institutions, insurance particularly, are traditionally quite insulated from tariff impacts. They also typically do quite well in a market downturn. Their revenue streams are more sensitive to domestic interest rates rather than foreign nonsense. So you've got companies like JP Morgan Chase and SoFi that have remarkably robust balance sheets. So they might actually benefit if the Fed responds with rate cuts to calm the market. Now, what about domestic manufacturing? Well, firms that primarily produce within the US and are less integrated into the global supply chain thing, well, they should benefit, shouldn't they? Take Caterpillar, for instance. It's a substantial domestic manufacturer. It may see increased demand as trade policies push production inwards into the US. And people are not going to buy the sort of Caterpillar type competitor that might be made in Korea or China or somewhere, and they're going to buy the domestic alternative because it is now cheaper. And then similarly, consumer staple companies like Procter & Gamble, Coca-Cola, well, they deliver essential goods. Well, they'll tell you it's essential. That's a whole conversation for another day. These firms tend to be very domestic in a lot of their manufacturing, at least their packaging. And they also tend to have manufacturing facilities in every single country in the world, so they can shift stuff around. So those sectors give us stability and actually growth potential here. And look, I could take you into the stock charts now here and run you through JP Morgan Chase and SoFi and Palantir and all of these and tell you what's going on there. But honestly, by the time you watch this video, the charts probably have changed. So it'd be much, much, much more useful for you to spend the next 10 minutes of your life to learn the rules that I would base my analysis on, rather than watch me run through this and then have to watch me run through this a few hours later again. So I implore you to use the pain and the fear and the suffering and the misery and the shock that most people are feeling right now, because their portfolios are redder than red, to sit down and go, how could I get better at this? And the only thing that'll make you better at this is if your skills get better. Yeah, you can point fingers and say it was his fault or his her fault, or it's manipulated or, scandal or whatever, but that won't actually change anything. And I tell you, the smart investors are making money today, this week, next week, and the week after. And when the recovery comes, smart investors are going to make a lot of money. Because really, if you think about it, if you walked into your local Costco and everything was 20% cheaper, you wouldn't be complaining, you'd be loading up. And that's the key here, is understanding, when do you load up? Is this going to go down 10% more or not? What are the hard rules that the most successful investors in the world use to determine when the market is genuinely rebounding? You'll learn that if you go to felixprehn.org/get-free, and you're going to feel a heck of a lot freer at the end of that, because you'll have more control. And that's my entire mission here, is get you to the same level of skill. And it's much easier than you think, by the way. There's only 3 things you need to learn, basically. And you'll come out of this smiling. And next time the market dips, you'll be as happy as me and Winston. So go and check it out. felixprehn.org/get-free. I love you for watching. See you on the next one.
Come on in here. Come on in.
Michael Burry is back. The legendary big short investor who predicted the 2008 crash just tweeted, "I'm back." And I quote. And that is just one day before Trump's Liberation Day tariffs. Is this timing coincidental, or is Burry